Joining us now, we've got Angelo Zino, Senior Equity Analyst, CFRA Research. Angelo, it's good to see you this morning. Happy Friday to you. I saw you making your rounds this week. I think I caught you on Bloomberg yesterday. All right, Angelo, let's talk a little bit about these results from Marvell. Look, they beat expectations for the trailing quarter. Adjusted EPS, 62 cents a share, revenue $1.9 billion. Guidance looked like it was in line with expectations to me. Shares under a little bit of pressure in the pre-market. Take me through what you liked first, and we'll get into where you may see some risks.
Yeah, so thanks for having me, Diana. And I'd say you look at the numbers, and I think you laid them out pretty good overall. I mean, the numbers were in line. The results, the guidance, I'd say, I think the most important thing going into the quarter and into the print here was more about what they had to say about their AI exposure, their custom silicon business. There was a lot of noise and chatter in the market here over the last couple of weeks and months tied to Marvell about their relationship with AWS and specific chip ramps that they were expected to see, more importantly in 2026 and not as much in 2025. But nonetheless, they reiterated their strong partnership with AWS, as well as the fact that product launches are going as planned. More importantly, again, 2026, there's a 3-nanometer product launch tied to AWS, and they reconfirmed that product, as well as the fact that they expect higher volume from that. They also talked about some other another hyperscaler that remains very strong in terms of engagement levels and their expectation of ramp as well going into 2026. So I think they did a really good job on the call, really kind of simmering some of those concerns that we've heard in the market here over the last couple of weeks and months. And I think that was really the most important thing that you needed to hear on this call. This could have really gone really badly, and we could have been talking about a stock down 15 to 20%.
That's a great point. Was there anything that concerned you at all?
I wouldn't necessarily say there's anything that concerned us. I would say, in terms of maybe why the stock isn't acting the way you would have hoped given that news, I would say, listen, fact that it was roughly in line when I think most at this point, this late in the earnings season, was maybe hoping for more of a beat. Maybe that was a little bit of a disappointment. And then on the margin side of things, gross margins, that was maybe the one disappointment as far as the numbers were concerned for the quarter, as well as on the guidance side. And what I'd have to say about that is when you look at what's really driving this company right now, it is that custom silicon business. The custom silicon business does have lower corporate margins. So as that business volume, as the volume ramps up here over the next couple of quarters and years, it's a headwind to gross margins, but it is contributing very nicely to the operating margins and the profitability. And that is more important, I think, for investors to look at.
Given that what you mentioned about its custom silicon ramps, do you think that assuages any concerns about competition?
Not necessarily. I mean, the competitive environment is going to be intense here over the next couple of years across the AI ecosystem. I will say this, a couple of points. One, demand for accelerators from a broader perspective is growing much faster than I'd say we just anticipated, 3 months ago. I would say within that, the custom silicon space, so that is largely Broadcom being the leader there, Marvell kind of maybe being more of a junior version of Broadcom. We expect to continue to be share takers here over the next couple of years and outgrow the broader custom silicon space. So the competitive landscape will be there, but nonetheless, the pie is growing so big, I'd say at this point, that there's enough for a lot of these potential winners out there, Marvell being one of them.
And then, Angelo, you've got a strong buy rating. You've got a $77 price target on Marvell for a 12-month price target. What are the catalysts that gets it there?
Yeah, so I mean, the biggest reason we continue to have a strong buy recommendation is one, that this pullback, I think, represents an enticing opportunity from a risk-reward perspective. It's now trading towards the lower end of its 10-year historical range. It is a much different business than what we've seen in the past, in the fact that they're more infrastructure related. They're actually very little consumer driven out there. So we think kind of the long-term dynamics of this company remains very much intact. In terms of catalysts, the next thing you have to look at in the calendar is June 17th. They've got a custom silicon event taking place at that point in time. We'll see what they have to say, but we expect an update on the total addressable market opportunity. We think it's going to be much bigger than what they talked about a year ago at their analyst day. And be on the lookout for potential new customer wins at that event. And that's something that we're excited to hear more about. So I think that would be the next potential catalyst on the calendar from Marvell.
And then, okay, so June 17th is a date to pay attention to for
Yep.
Marvell. And then you adjusted EPS estimates slightly for fiscal year 26 and 27. So what's driving your view on margin and revenue progression from here?
Yeah, I mean, I'd say, we tweaked it a little bit on both sides. I mean, I think we upped it a little bit for this year and cut it slightly for next year. But and it has just more of us tweaking the margin numbers slightly. But when you kind of look at the dynamics here, it's going to be driven by two factors. Again, one, it's the custom silicon business, and the other is their connectivity business, and that is kind of taking a little bit. Maybe slow down a little bit right now because there are some concerns that right now because of China, Nvidia with their H20, and that is going to impact them a little bit. But nonetheless, I mean, those are going to be the two key drivers. They've got a non-semi business which has is down about 40-45% from peak levels seen in 2023. It's now seen 4 sequential quarters of a rebound. So we do think it's recovering. It's recovering much slower than we previously anticipated. But nonetheless, the worst, at least in their non-AI businesses, look like we're well past that.
Okay, all right. We'll leave our conversation there for today. Thank you, Angelo. That's Angelo Zino, Senior Equity Analyst, CFRA Research.